All right. So you have joined the 2024 Wage and Benefit Reports Insights and Analytics Tool webinar. Today, we are going to cover year over year in regional labor management trends. I'm going to show you our new data-driven real-time analytics tool where you can filter down by region, state, position, and industry segment. We'll go over a summary, kind of an executive summary of the reports, policies, overtime, health insurance. I'm really going to drill down more into a micro analysis to start, and then Matt will finish us off with more of a macro, what's happening in society today. We'll look at key trends and insights for data points from year to year and regionally. And then we'll talk about how you utilize these competitive salary strategies to boost recruitment and retention for your own organizations. As I mentioned earlier, there are 15 APAN sister associations across the country, all contributing to these reports with nearly 400 companies participating in the reports. It's really rich data that goes back to the data goes back, we've been doing it since the 70s. However, these associations have been a part of the industry since the 1800s. So thank you to each of them. And special thanks to L.B. Carlson, who is a sponsor of this report. And without their help, building the new real-time analytics tool would not be possible. So we appreciate being able to work with them. Thank you. All right, let's jump in. For those of you that are familiar with the reports, they are the most extensive and reliable year-to-year labor management reports in the graphic communications industry. They go back to the 1970s. I already mentioned nearly 400 companies participating this year, but that's bringing us over the last several years, 835,000 data points. There are 200 plus positions and descriptions that are covered, and the full reports are broken down by region, company size, and then you also have 4 special reports for industry segment. So each region has their own report, as well as shared reports for packaging, tag, and label, for digital-only printers, for in-plant printers, and then, of course, for union printers. All of these are available to members through each of those sister associations. In those reports, there's a lot of data, so it certainly is something you need to take the time to look at the format. This is an example of how the wage data is broken down. If we look at a sample of a cutter operator under a bindery category, this one's showing one of our sister associations broken out. And then it gives you kind of an explanation of which of those columns you should be using and what it means to you. So a difference between the average versus the median. The P90 are those up to 90%, where we're breaking out those that are in the highest group separately. And that's important. When you see that highest for all participants at nearly $38 an hour for a cutter operator, some in my region might say, wow, that's excessive. But if you look at those up to 90%, we're at $27 an hour. Well, that's a $10 an hour difference. That's a big deal. So definitely pay attention to how these categories are broken out and what they mean to you, because each one is significantly different. Benefits data is broken out in a similar way, where the question is on the left, and it's important to think about how the number is being reported. So when we look at average employee count, those are actual numbers: 68 employees, 58 employees, nearly 78 employees. But when we jump down here to policies, companies that have a written drug-free workplace policy, these are percentages. So it's really describing for you fixed amounts versus hours are the actual number versus most of it is in percentages. So companies that test for drug and alcohol, this is 33% in the Northeast, 41% in the Southeast, 50%. So the middle of the country is testing for drugs a great deal more than those on the West Coast. these are how those regions are broken out. So really the western portion of the country, and then north central, south central, northeast, and southeast. You'll see those in the reports as well to help you figure out where you are. But our new analytics tool is going to even let you drill down by state. That's important so that you know that there is a big difference across the country in some areas, and in other areas there's not. When we look at wages, we actually report them first by region and then by company size. So this is a snippet from the front half of the report. I used Mail Machine Operator to give you an idea that half of them are reported as hourly wages, and then Estimator down here, the other half are reported as salary wages. And so it's important for you to recognize the difference there as well. So by region first, and then the second portion of the report is by company size. Then we really do the same thing for benefits. So first by region in the third portion of the report, and then the last portion of the report is by company size. So here, if we're looking at bereavement hours, it's telling you all participants are offering approximately 10 hours really across the board. Fewer hours in the West and a little bit fewer here for larger company size. But then when we get down here to health insurance, companies that are offering a PPO plan versus an HMO plan, those are percentages. So if we look at all participants, we have nearly 61% offering a PPO, 24% offering an HMO. If we compare that up here to our regions, you can kind of see the differences there as well. South Central offering 68% for PPO, but nearly 18% for HMO, and that's different compared to what you see by company size. So a lot of information and a lot of data to decipher. I really want you guys to jump in and ask questions as we go because there's so much data, but we're going to take a look really quick at our new real-time advanced reporting tool. It's an online tool that really allows you to sort by the role or the position, and then filter by more specifics. This is how that page looks, and for instance, in this case, we selected folder gluer operator. But let me take you right over there and let's do a demo of the actual live portal. Matt, can you see that portal?
Yep.
Terrific. Okay, so over here on the left, we're going to be able to go to, for instance, a folder gluer operator. Less is more when you use this search field so you can see what your options are. So here you're looking at a folder cutter operator versus a folder gluer operator versus a specific size folder operator. So if we go to, let's say, folder gluer, it's really going to give us data year over year from 2020 through 2024. If you hover over these dots, they're going to give you specifics for those years, and these are going to give you averages across the country. So it's really looking at 7,300 data points with a minimum salary or hourly wage of $6, the average at $23.63, and the max at $39.45. If we adjust the years, we can take information in and out of here. If we take out all of them and say we just want to do the last three, if we feel like maybe the prior years were impacted by COVID, you can see that we actually have a decline. Now that is, of course, across the country, going from a maximum or an average of $25.59 an hour to $23.90. Not a huge jump, but with more limited data, we've cut our data points nearly in half. You can see that decline. If we add a region and maybe say, let's just look at the North Central region and we compare here, wow, there's a big difference. We just had a minimum of $6 an hour and that jumped to $15 an hour. That's pretty significant. The average went up, and then of course the maximum went up as well significantly. Of course, we can reset this. And then let's look by state. So we chose North Central. We have attendees on from the Minnesota area. So let's look at Minnesota. Again, those numbers climbing. So we went from 6 to 15 to 17 over here, up to 20, nearly $28 here. And then that maximum wage is coming from the Minnesota area at $39.45 an hour. If we, of course, we can reset these and we could choose Printing Industry Midwest, which would be, of course, Minnesota, the Dakotas, Iowa, Nebraska. You're going to see a slight decline there. And that average at the top. So here in 2024 at $26.91 an hour, nearly $27 an hour. Janie, you have a question?
Yeah, we've got a couple of questions. I'm sure this is on a lot of people's minds. So if we can go ahead and answer it and then people can continue to focus. How do you get into the portal?
Excellent question. The information is data specific. So we're really interested in your data. If you participated in this year's survey, the 2024 Wage and Benefit Survey, you should have received a PDF report from your sister association and be able to log back in and get access to this advanced reporting tool. If you don't have access, reach out to your sister association. And if you're not sure about that, you can contact, my information is at the end of the slide, end of the slideshow, and I'll get you the information to be able to log in. But great question. All right, if we reset this and we say, let's look by industry segment for the last 3 years and go to a general commercial printer, what do we get here? We go to general commercial printer. That's where you see that minimum wage over here at $6 an hour and those averages. What if we looked at, since we're looking at a folder gluer operator, a binding and finishing company, an organization that specifically said, this is our industry segment. Here we jump up to nearly $15 an hour, $25 an hour at the average, and then $32 an hour for the maximum, which is really interesting as well, because when we looked at the North Central region, that was up at $39 an hour. So there, they have potentially a more qualified pool of candidates demanding a higher wage. Any thoughts on that, Matt?
Yeah, I think definitely hit the nail on the head on that. You know, this tool definitely can help identify areas where regions are paying more for the same skilled labor somewhere else in the country, and or where they're demanding less. For example, you know, the North Central region at $39 an hour, that could mean more skilled labor, or it could mean there's more of a shortage, right? Where they're having, companies are going to have to pay more because there's not as much in the talent pool. So different things can be gleaned from that, but this tool definitely will help provide some insights for companies and organizations to remain competitive and to try to offer the maximum amount possible while still being kind of in industry standard.
That's a really good point. It could prove that there's more competition there that's driving the rate up. If we looked at, for instance, Mid-America, the South Central part of the region, Missouri, Kansas, Oklahoma, Texas, you see that $6 go to $12, but we're not at the $25 an hour here or at the $39 an hour there. And that may mean that we have a bigger pool of candidates, and so it's not as competitive. We're going to get into more detail about this, but certainly we have seen even where from year to year it has changed based on the availability of candidates that are skilled. And so some positions continue to climb and others, like entry-level positions, have declined for an hourly wage. So interesting segment here. Let's try another position and maybe we go to a jet press operator, an envelope press operator. And if we look for that 5-year period, you're going from a minimum of 14 to 22 to 31. If we go back to that 3-year period, you see it go from 14 to 17 and so forth across the board. Let's look, let's try Minnesota again and see how it compares. Oops, apologies, I needed to reset this. You just saw where I had not reset the filters, and that's a really important part. I had Mid-America selected, and it's telling me there's no data available because there are no Mid-America members in Minnesota. They would be PIN members. So if you're not getting what you think about, you need to make sure we have those filters correctly. So again, if we're looking at Minnesota, we're going up to $43 an hour. I know that we have some members on from GMA. Let's look at GMA here, and you can see where they are, where the minimum for Minnesota was $20 an hour. They're at 15. They're not very far away, being Ohio, Northern Kentucky, Michigan region. Their average is $24 an hour, and their maximum at $31 an hour. But if you recall the previous screen for Minnesota, it was at $43 maximum. So quite a jump there. If we reset this and say, let's look at this from a industry segment and maybe consider general commercial printers, or mailing houses, how do they compare? And it climbs a little. We could potentially add envelope converters in here, see how that compares, and get a much better idea of how it impacts us. So that's really on the jet press operator. If we reset all of these and let's go with a totally different industry segment and look at maybe wide format. That's something that general commercial printers have really embraced. A lot of general commercial printers have put in either roll-to-roll or flatbed and even router cutters. So if we look at a wide format finishing laminating technician, all across the country, we show a minimum of $10, the average at 20, and then the max at nearly double. Okay, so let's look, let's look at 2 regions. Let's look at the middle of the country, which is going to include our Ohio members. And you can see there where our minimum jumps up, but it's changing a little bit. Let's look at maybe just our members in Texas. And it actually declines where we were at $39 an hour and it's 27 just for Texas. We were nearly at 25 and it's 18 for the average. So that's an interesting element. Let's reset this and let's look at just those that consider themselves wide format companies, not general commercial printers. Interesting. And so when we look at that specific group, it's lower than what we've found in general with all commercial printers. Let's take this one out and let's go with general commercial printers. Interesting. And so the minimum is lower, but the maximum is considerably higher, $10 an hour higher. And we could probably have a discussion on what that means. Would we consider that most of our wide format companies maybe don't have the capital investment that the general commercial printer may have invested? So it's more sophisticated equipment demanding a more skilled operator. You could probably glean a lot of discussion points from that. Matt, any thoughts?
Yeah, I think it just comes down to maybe the more skilled equipment that a specialized printer compared to just a general commercial printer might have. Might also, be related to what each company considers themselves to be, and maybe that might be skewing the numbers a little bit. But overall, generally, the more sophisticated equipment, generally, from what we've seen, is garnering a higher wage.
And you can see here where the average is climbing from nearly $20 an hour in 22 to a little bit higher in 23 to nearly $21 an hour in 24. So as you try to plan for your labor expense, how does this impact your efforts? All right, we're going to go back to this slide presentation, and I'm going to run through some more micro details, and then we'll talk some more. So if we take that data and we try and run some reports to look at trends in wages, this is a lot on one screen, but I wanted to show you the average salaries for department managers by year and where they've come from. Here we show, a wide format manager average salaries took a dip in 22, but exceeded digital print managers in 24. And so this purple one here at the bottom is your wide format, and your digital print managers is that green one here. So it's an interesting aspect that the wide format would bypass a digital print manager. Of course, some of that has to do with how you label it. But then up here at the top, of course, is going to be your press room managers for sheet fed and web, and they're going to be more at the top, more skilled labor, and they really continue to lead the charge. So this same data, if we break it down by region, again, it looks like it's over all over the board, but we really see a considerable difference for wide format managers from coast to coast, really with the Southeast dipping down and the West jumping way up. So here's that purple line again, that's your Southwest, and then that's the West Coast, or I'm sorry, Southeast and then West Coast. A pretty considerable difference. All right, let's look at our typical 40-inch litho press operators. We usually classify those 38 to 42-inch press operators, and we could add second press operators in here. We could add more details in here, but you can see where we're breaking it down by 4 or 5 color, 6 color, 8 color. And so those 8 color press operators continue to climb and lead the charge. And the fewer colors, the lesser the hourly wage. All right, again by region, and it changes it considerably, where here you see kind of a dip for those 8 to 10 color press operators, depending on where in the country you're located. And again, the West Coast demanding a much higher wage. Potentially, we don't have as many qualified or skilled labor operators there, or maybe more competition. I know we have a couple of Flexo members on the call, so we'll talk briefly about Flexo press operators. Here we're looking at 9-inch, 10-inch, or less than 9-inch, or greater than 9-inch, 10-inch, and then our Flexo plate operator. So here you have the plate operator not running a press, and we're seeing their wage decline slightly in 2024, where the 10-inch wide web press operator is continued to increase. And then you see it by region here, where that Flexo press operator in the West really dipping down to nearly $20 an hour, where they were paid a great deal more, nearly $30 an hour in the Southeast. So a considerable difference. All right, finishing and binding positions are always a challenge because we have lots of them, and they oftentimes come in as entry-level workers and then move their way up. Here I'm showing you automated die cutters compared to just cutter operators, or multi capability operators, folder cutter, folder gluer, perfect binders, stitchers, and really they've kind of leveled off in the last year or two, where some of them took a dip in 22. Again, these are all across the country by year. Let's look at it by region, and it really kind of jumps around a bit here. So if you look at your 28-inch cylinder die cutter, they took a dip in the West. So the West has a significant difference compared to lots of the others that seem to be consistent from year to year. All right, when we look at projected wage adjustments, the average adjustment for all the data in the last year is 2.6%. But I take these screenshots from those reports because it's really interesting. The companies adjusting wages in the past 12 months for existing staff is pretty significant at 45% on average. So we're looking at it by region, and then we're looking at it by company size. Adjusting wages for the last 12 months, only about 25% of those participating adjusted it in the West, but in the Northeast, it was nearly 60%. Quite a significant difference. South Central and the West leading in wage adjustments, but a slight increase in company size. If we look here, 76 to 150 employees, 61%. So again, some interesting details. Now, Matt, I don't know if you wanted to comment on this one, because when we try to average or we look at all of the data, we may say 2.6%, but in fact, we know that some are just to keep the qualified labor significantly more than that.
Yeah, I think if we go back to the analytics tool and some of the other graphs that you were showing, Teresa, it was pretty clear that some of those skilled positions are increasing faster than 2%. We saw that there was maybe $2-3 an hour jumps in some positions, and ultimately there were some that were declining. I think the plate maker, or plate setter, for one example, decreased. I think it was $1.50. So while they're an average of 2.5 to, in some spots 2.6 overall percent increase projected in the next 12 months, that's just an average. And obviously some positions are going to have to have more of an increase in order to retain those employees compared to maybe some that you don't have to do as much of an increase, because that's just not what the market's garnering. So really that analytics tool can really help pinpoint where those positions maybe need to have a higher than a 2.6% increase, and then those that maybe don't need to have as much. But each region is different. Each, obviously, state is different. Each company is different, but that tool should help quite a bit in order to retain employees.
Great point. All right, let's look at trends in benefits. So we start with shift differential percentages by year, and you can see here second shift climbing really from 8 to nearly 10%, and third shift really kind of leveling off at just above 11%. Of course, those working third shift do tend to have a higher shift differential. If we look at the data by region, you can see here that really the West shows the greatest increase, while the Southeast dips considerably. So here's going to be our North Central members, Northeast being here kind of leading the charge, with South Central just behind them, but Southeast really takes a dip. All right, if we look at it by dollar amount versus percentage, here you're seeing really the max second shift dollar amount drop slightly this year, where the max third shift continues to rise. And so these are those maximum numbers for comparison. And then by region, wow, the West again takes a dip. Third shift dollar amount in the West continues to decline while second shift continues to increase. We looked at production shifts by region across the country. There did seem to be a push for more flexibility, more opportunity to potentially work fewer days and get people to come back to the workforce. But really, the Southeast here leads for companies with only one production shift. Northeast leads by a slight margin for those with 2 production shifts. And then North Central has a considerable lead for those with 3 shifts. So interesting how different parts of the country accommodate the work over different shift availability. Drug policy is also kind of interesting with decline slightly for 2022. And that may be related to many of the states moving towards legalized marijuana. Any thoughts there, Matt?
You're probably correct on that, Teresa. I was kind of surprised when I saw this a little bit, but if you look at the trend over the past 3 to 4 years, it has come down, and that can only be attributable to the relaxing of the various laws in states, and because of that, companies have shifted their focus away from maybe having drug policies as much as they used to. They're still pretty high. I think, there's still above 80, 70%, but not as high they used to be.
Interesting. This is drug policies by region. And so you can again see where certain regions, it's much more significant, North Central, South Central, but dropping in the Northeast and certainly dropping considerably in the West. Those that drug test for random at cause for new employees or an accident. And then this green bar at the top is those companies that test for drugs and alcohol.
And Teresa, if we go back to that slide, actually, it probably just further illustrates that point. The North Central and maybe the South Central have states that maybe don't have as lax of drug policies, and obviously the West Coast, the Northeast have more states that do. So that would tend to probably confirm what we previously discussed.
Right, really, from Colorado over, they have more lenient drug laws now, which this would support. All right, even things like jury duty, parental leave, and voting by year has an impact. And so companies with paid jury duty and voting time off continues to decline, which is really surprising. But this may be due to more early voting opportunities in states that weren't there before. If you can vote on a Saturday or vote a couple weeks in advance, they don't need to allow for as much time off. Paid parental leave has a slight increase though, and so those family values are making an impact. This is by region, of course, and so the West lags considerably for paid jury duty, and the Southeast lags for paid voting time off. So you see those numbers kind of dropping here. All right, days per week by year, we thought we would see a significant decline here, but we do not. 5 days a week continues to hold strong, with small percentages offering predominantly 4-day or 3-day work weeks. Really, after COVID, it was predicted that these would increase and the 5 days would decline, but you don't see that happening. If we look at it again and compare by region, across the country, the Northeast reaches nearly 15% of companies for predominantly 4-day work weeks, where the West doesn't even make the charts. So they aren't offering it really at all. Interesting comparison. Overtime is always interesting. If we look at it by year, they remain fairly consistent by year, and this is measuring how they pay. 40 hours earned, 40 hours worked, or paid upon shift completion. Here it is by region. Overtime based on 40 hours works leads in that policy mandate, with more than 30% of companies in the North Central region basing theirs off of 40 hours earned. All right, overtime holidays, Saturdays, Sundays. We wanted to look and see, has there been a significant difference in time and a half versus double time? And you don't see a huge difference. Saturday time and a half drops, but the rest remain fairly consistent. Holidays lead for double time versus Saturday and Sunday is still at time and a half. So I think if you're in that area, it's consistent to say this is what is standard across the region, really across the country. If we look at it by region, you can see here that the West offers more double time after 4 hours of overtime and some Saturday double time when it's not really offered across the rest of the country. Time and a half leads as the considerable policy for holidays, Saturdays, and Sundays. So this blue bar over there for the West really climbing up, where it didn't even make the charts again for Southeast or Northeast, and very limited for the central portion of the country. But here, apologies, in the West, they're reaching nearly 20%. All right, how's vacation faring? Are people gaining more vacation? Are companies having to offer more to retain or recruit employees? So we looked at vacation by year, upon hire, after 6 months, at 1 year or at 2 years, and really 2021 into 2022 led with 2 weeks upon hire, but then really switched to 1 week after being there a year, primarily in 23 and 24. So the numbers, this blue bar is decreasing, not having to offer 2 weeks paid vacation upon hire, and this red bar increasing, where offering a week of vacation after 1 year is really leading the policies. If we look at it by region, North Central has more than 20% of the companies offering 2 weeks vacation upon hire, with the Northeast being more conservative and offering 2 weeks of vacation upon 2 years of employment. More conservative than we would typically see from the Northeast. And then, of course, healthcare, which is a challenge for all of us. If we look at health insurance programs by year, this slide is really showing the type of programs that they offer, a PPO versus an HMO versus self-funded or no plan at all. And by far, PPOs lead the charge across the country with nearly 70% in 2022, but definitely above 60% for all other years. If we look at that by region, certainly the Northeast and the West lead with HMOs, but North Central leads for self-funded plans, which is really kind of an interesting aspect as well. Any thoughts there on what's going on in the North Central region with self-funded plans, Matt?
I don't know. I did see this as an outlier, Teresa, when we were looking at this, and it kind of caught me a little off guard. But that just might mean that those companies have either better programs in place, or lower experience ratings, or they have maybe a healthier base of employees. I guess I don't know. It just
Interesting thought.
Yeah.
To be self-funded, it may show that there are very stable companies in that region compared to You know, if we look at this red bar across the board, we have the fewest in the Southeast. That's a pretty big comparison. So an interesting topic to analyze. All right, if we look at it by company size, we haven't done this a lot, but it certainly seems to make a difference. Small companies on the left, larger companies on the right. We do have nearly 15% of our small companies not offering a health insurance program, and very few of our very large companies. PPO is certainly the leader for all of the companies, but offering some type of plan being offered to every or the majority of the industry is strong and exciting. If you compared that to the restaurant industry, I think you would see these probably turn upside down, where they don't offer as many benefits to their employees. So something very good that our industry does. All right, this is something, percent of employers that are covering health insurance by year. And these are great numbers. So really, that first blue bar is showing employee only. 70%, nearly 70% across the country is covering a percentage of the health insurance for that group. It drops slightly for employee plus one, really kind of grows a little for employee plus a child, and then the orange is employee plus family. So doing a lot for the workers in our industry. If we compare here by region, kind of interesting, again, the West leads in health insurance coverage over here on the right, but we're going to see some differences with, they tend to put their money here, and not maybe as much in retirement programs when we get to those slides. All right, percentage of employers covering health insurance by company size. This I found really interesting because here our smallest companies lead for employee only coverage. And you would have thought that this would have been the 150 plus employers. This is likely a sign to get them to work for a small company. They have to offer more in benefits. And so the printing industry is oftentimes defined as mainly sole proprietorships and partnerships, very, very few huge corporations, and definitely considered at times small business, more printing companies that are small business than a compared industry like automotive. All right, I think this is the one where Ben said, tell me the difference here. Average percent covered by those employers that are paying some of the health insurance cost by year. So when we look here, while cost sharing percentage has decreased for employee only over the last few years, it has increased for families. And so it's very much leveling off, where we had such a extreme in our bars in 2021, and they're catching up with each other here. This, of course, is the average in the actual reports. The maximum percentage and the minimum percentages are reported and compared, and fixed cost is also compared, where, again, these are averages, but an interesting statistic here where it's leveling out. Matt, any thoughts on insurance?
Yeah, interestingly, to your point, Teresa, that more firms are sharing more cost in the employee plus child and family. And I think that could be mainly due to the price of those plans typically are accelerating and increasing faster than maybe some employee type only. Now, not all the time, that's obviously a gross generalization, but and trying to remain competitive, companies maybe have to provide more just to keep those benefits affordable and or retain those employees. And or it could be related to that there's more employees that have families now, and they're shifting towards now having to cover more, as far as there's not as many single workers in these companies anymore. So there could be a couple different variables, but that's just generally maybe what the data is pointing to.
Interesting. Let's look at it by region. So here you see North Central, Northeast, South Central really leading the charge in the percentage being put towards health insurance coverage. And then you see it dropping off in the Southeast as well as kind of the West on both coasts. Really a greater difference considerably. Again, I'd have to say the maximums and the minimums are reported in the actual reports, but these are the averages and very different than year to year versus by region versus by company size. So here you have larger firms covering more for employee only and smaller firms potentially not able to cover as much, but still a significant amount. All company sizes covering more than 50%. This is that retirement and profit sharing that I mentioned, where you really see most of our industry focusing on 401k plans. Absolutely the most popular in matching. However, profit sharing plans really remain about the same from year to year. Here, when you look by region, really, again, North Central, Northeast, South Central, very high in terms of companies with matching 401k programs, but it drops to nearly half of that in the West. But we saw them putting a lot of support towards health insurance, and maybe that's a sign that there's less on this side, where the West lags. Turnover and job absence have been something that we have been looking at trying to track more closely over the last few years, particularly with what happened to the workforce during COVID. And so really that blue bar is telling you this is the number or the percentage of companies that are tracking employment turnover, and that's declined. Less are tracking it with approximately 15% turnover the last 3 years, and then fewer track job absence with a decrease in absence in 2024. And that may be signs that the workforce is healthier and stronger post-COVID, that we have a decline in job absence from year to year. Again, if we look at it by region, Southeast leads in tracking employment turnover, and the West doesn't seem to track job absence at all. And so it may be less significant for them there than it is in other parts of the country. And then I wanted to look at it by company size. So here, larger companies are able to track more. They have potentially more team members and they show more turnover. But for job absence, smaller companies track more. But absence seems to be consistent across all size groups. So I found it interesting, those that are tracking versus the actual numbers that they're tracking. Any thoughts here, Matt?
The larger companies, Teresa, might have more resources in order to, in time, to track employee turnover. You know, the smaller companies might be more focused on just, you know, performing the work and might not have as many managers or whatever the case may be to track it. And then just might be because a smaller company, you definitely can feel if an employee is turned over or not more compared to a larger one. But it is interesting that the job absences, regardless of size, are about the same across the spectrum of organizations.
Right. This green bar here showing employee turnover and it being really kind of considerably lower in the smaller companies. Some have attributed to more of that family feel versus maybe a more corporate environment where you might be feeling like you're just a number. So more may be apt to leave a job here versus a family environment. Thoughts there?
That's probably a good generalization. You know, typically smaller companies do have that smaller family, quote unquote, family feel. And generally have lower turnover compared to the larger companies that are more of a corporate feel. So that's not too surprising that a 1 to 25 employee company has less turnover than 150 employee company.
Mhm, mhm. Interesting. All right, other incentives have become extremely valuable. A lot of our workforce is looking for other recognition. So we looked at everything from bonuses to charitable donations. And of course, bonuses lead the charge with gift cards or gas cards or giveaways behind that with free company branded gear. So if your company is doing that, that seems to be very popular. It really kind of dropped off in 2023 here with this pink bar, but it climbed back up in 2024. And then you have company picnics and recognition and so forth. If we look at this by region, again, it's kind of interesting because the North Central and the Northeast really lead in many of those efforts with less impact on other incentives in the Southeast and the West. In fact, when you look at some of these numbers, it's interesting to see them drop off as you go across. All right, I want to mention the federal employment summary for October of this year really shows the national unemployment rate at 4.1%. Last year at this exact time, it was 3.8%, so not a huge difference. Employment in manufacturing did decrease last month, but over the past 12 months, the average hourly earnings have increased by 4%. So again, interesting statistics for consideration. And I am going to turn it over to you, Matt, and let you kind of talk more about the macro element of what we're seeing in terms of how this impacts society and the workforce altogether.
Thanks, Teresa, and definitely a lot of good information there on the slides and a lot of detail that can help companies kind of navigate these times of competitive kind of wages and benefits, and hopefully they can, you know, use these reports to really retain these employees. You know, this report definitely provides a lot of information, like I said, to where companies can review and hopefully manage their labor costs. You know, are they overpaying for a position? Are they underpaying for a position relative to their region, relative to their state even? To really help pinpoint and manage their labor costs. Labor costs are one of the biggest manageable expenses that any printing company faces, that just a small percentage change can really affect profitability and sustainability of the organization. So this report definitely can help guide those and give insight to what peers in the industry are doing, not only across the country, but obviously, like I said, in the state and the region. Kind of wanted to go back a little bit and take a step back. You know, in a couple of slides ago, you mentioned the respondents saying they were planning about on an average 2.5–3% wage increase over the next 12 months. That obviously is keeping up or slightly below inflation, which inflation's around 3.1, 3.2, depending upon where you look and when you look. But the previous slide you just mentioned, you know, the average 12 months across the board in the nation was 4%. So wanted to draw attention to the industry is not only competing with itself for skilled labor, but it's also competing with outside industries that might be offering a higher percentage wage, but obviously our industry might be offering more benefits or better benefits. But just wanted to provide that contrast that, you know, as we're looking to potentially retaining or attracting new employees, that other industries on average, we're looking at 4% increases going into the next year. So something to be keeping in mind. But with that, definitely organizations can use this report to help benchmark their benefits. You know, you gave good detail, great detail on the health insurance, what percentage is covered, what is offered. Obviously, that's the biggest benefit that outside of wages that a potential employee or a current employee is looking at as far as affecting their lives. So benchmarking your organization to kind of what the industry is moving towards can really help provide insight onto, do you need to do more, or can you do more, and provide more. Interestingly enough, when we look at the previous slide, a lot of firms and respondents are offering additional benefits that aren't necessarily bonus related. Bonuses actually were down as a whole in 2024 compared to the prior years. That's not necessarily surprising, given I think the overall industry has kind of softened a little bit compared to the gangbuster years that were had in 2022 and maybe into 2023. But with that being said, you know, like you mentioned, company swag, charitable donations, company picnics, entertainment ticket drawings, gift cards, gym memberships, even remote days are all up. And not all of these things cost money or a lot of money compared to wage increases, but they are affecting retention. And kind of like we mentioned in last year's survey and webinar, we expected probably some of these benefits to increase, and we're seeing them in 2024 increasing. I'd expect that increase to continue as companies are getting more creative in ways to retain their employees. Things like remote days, like I said, don't really cost that much money, but or any money. But if you can get an employee to work remotely, that might keep with retention or whatever. So just keep that in mind as we're looking at this survey. There are other ways that maybe are less expensive to help retain employees, and that's kind of where, like I said, the trend is going anyways. Next slide. So, you know, I hope this is one of the last years we're going to kind of talk about COVID, but I do see, and we do feel, I think across the industry, the job market and the industry and the economy is kind of coming back to a new normal. You know, from 2020 to 2022, we experienced a lot of paper allocations, very competitive job market, very, very low unemployment, scarcity of even capital equipment, everything. Obviously, that kind of led way to the slower industry like we experienced the last year for sure. Interest rates are now finally starting to come down a little bit. Access to capital does seem to be a little easier. Headcount, employees are able to be found a little easier now. There's still a mass shortage, but it is not as bad as it was in 2020 to 2022. I do want to kind of glean a note. I made a note here, Teresa, that unemployment, you are correct, is around 4%. But if we actually look at the manufacturing industry itself, that's in the low threes in some regions. It's nationally 3.6 overall. So what's driving that unemployment being around 4 and higher is not necessarily manufacturing. It's the retail sales, it's the professional services, it's the restaurant, all of those type of industries. So there is still ongoing labor shortages, like I mentioned, not to the extent they were in 2020 through 2022, but our industry is still experiencing labor shortages, and I think that trend is forecasted to continue into the future. Overall, the economy is showing positive signs and trends. Like I said, interest rates are a little lower, inflation has come down, and unemployment is not so low. I mean, it's at a healthy number now. The positive sign that a soft landing can be achieved and a recession can be avoided is somewhat seen as happening. So how that impacts labor, hopefully that means that, you know, companies are optimistic for the future and have a pool to at least either hire people and or make commitments to capital expenditures to help augment some labor shortages, and we'll get to that in a little bit here. But overall, I think I just looked up the overall manufacturing industry as a whole is projected to increase at a modest 1.6% next year. I think optimism in our client base and nationally in the print industry, they are optimistic that it's going to be better than 2024, but obviously not maybe as great as it was a couple years ago. So a little bit of a rebound, but it's been tough. It definitely depends on what type of printing and what type of markets you serve in that printing kind of space. So, but overall, positive signs that a recession can be avoided, which will only help with the labor market.
Matt, there's a comment here from one of our panelists, and that kind of goes back to what you talked about as maybe alternative perks. They're not necessarily all related to bonuses, that there's other ways to recruit and retain. What are your thoughts on pet insurance or volunteer days or company event days? Is it something that we should add to the survey for next year?
I think it's a very good idea to add them. And frankly, it didn't pertain to this industry, but I was talking to a different client and they said an applicant actually asked about pet insurance and they decided to go with a different company because they offered pet insurance. And I thought they were joking, but this is actually becoming one of the, I guess, a deal breaker in some instances. So to that end, any additional benefits that company, we can add to the survey, maybe even a write-in. What else do you guys offer? Because I think companies of all industries are getting creative to, attract and retain employees. And some of them are head scratchers, I'll be honest with you. But I guess that's where we're going nowadays.
Interesting. Very interesting. All right. Are you ready for the next slide?
Yep.
All right. Let's talk more about recruiting and retention strategies.
So we just got done talking about, obviously the labor market's a little easier than it was, but it's still very tight. And that trend is not going to reverse. It's probably going to continue as we are seeing younger, entrants in the workforce, not, coming in as fast as retiring employees are, and or their current employees are switching industries. Like we mentioned, they're looking at maybe they're getting a higher pay, they're not considering all the benefits, whatever the case may be. They're either leaving the industry because of retiring or going to a different one, especially the lower skilled, non-experienced people. So what can we do as an industry to kind of help support our growth and or our sustainability as we're having difficulty finding employees to replace them? Definitely looking outside the state, considering remote employees in areas and positions where you don't have to be on-site present to run a machine or whatever. Can your estimators, can your billing department, can they be out of state? Can they work remotely? Can they work in a different part of your state? That would open the ability up for a broader pool. If you're able to not have to require to be on site, obviously you're going to open up a broader pool, or even offering remote remote days to employees of your current employee base. We saw that trend continuing of now companies are kind of going back to 2022, 2021, where they had more remote employees than they did in 2023. Keeping them a hybrid may affect retention or will affect retention. So one thing to keep in mind, are there those type of things? Can you utilize, artificial intelligence? It's always on the rise. I'm probably sure you guys are tired of hearing about artificial intelligence. It probably won't go away anywhere. It probably will be leveraged more in the future, but companies that utilize artificial intelligence potentially can replace headcount that are leaving or help, maybe utilize current headcount in a different capacity and really rely on artificial intelligence and or streamlining their workflow process. So maybe on the estimation and bookkeeping or billing side, can you streamline that process and alleviate some headcount to then maybe go to a different avenue to help, help with a different part of the business. Building smart plants, investing in equipment that takes less people to run or is more advanced is definitely going to be the future. With interest rates coming down, companies now again are able to potentially invest more in CapEx to strategically position themselves so that they don't have to have such a large employee base in order to make the same product. Not pertaining to our industry, but I was at the supermarket the other day, and 5 years ago they'd have somebody riding one of those floor cleaners around all day cleaning the floors. Well, now they've got just a robot cleaning the floors the entire day. Are there aspects like that we can invest in capital equipment in the printing industry to maybe alleviate the headcount or have them refocus headcount somewhere else? Also building and upskilling our current employee base. Are there people in our employee base that we can train or cross-train to help facilitate, running machines when they're maybe not as busy, and or promote so we can bring in lower level skilled employees and or temp agencies to backfill lower end machines or processes. We have employees currently. What can we do to get them to be higher skilled? And then, like I said, backfill with potential temp agencies, part-time people, whatever the case may be. So I think there are strategies that we can do with our current client base or employee base to give them an opportunity to make more money by training them, augmenting, their work schedule by having hybrid opportunities so they maybe feel a non-cash benefit and are more likely to stay. And if nothing else, utilizing AI to maybe help take some of the remedial tasks away from them to give them more purpose for the positions they're in.
Interesting, very interesting.
Next slide there, Teresa. Kind of wanted just to hit the last slide here on things that are affecting the labor market outside of maybe even our control. The international landscape, war and unrest, there is a couple of unrests and wars going on in Ukraine and the Middle East now that could ultimately affect the economy and inflation. Kind of the three may, cause a slowdown, which could, obviously affect how many applicants are available and or the pay. It could do the opposite as well. The next administration for the president is coming in January. They definitely have grandiose plans to bring back manufacturing to the United States. What that means for the labor market will still be on, obviously is to be seen, good or bad. The proposed tax increases, decreases in areas, tariffs, all of that will have an impact on the labor market. So companies definitely, as we move into 2025, will need to be keen and aware. Using this study obviously will help, but kind of be forward thinking and have to be reactive to the change that ultimately could come in the next year or two.
Interesting. Definitely, I think our entire country is hopeful, but lots of change happens with the new administration, and so we'll have to wait and see how that plays out.
Definitely, and that's kind of why I want to just put that on the slide, Teresa, so people are aware of keeping their heads up and hopefully be able to react as accordingly.
Good point. Thank you, Matt. Definitely, we want all of our members to be able to access these reports. As I mentioned at the beginning of the program, it is those APAN sister associations that get access to you. So if you don't have access, reach out to your sister association. If you're not sure who your sister association is, you can always email us at info@piamidam.org and we'll point you in the right direction. Or you could certainly contact myself or Matt and we'll point you in the right direction. We are really at that point in the presentation where we're going to open it up for questions and comments. We encourage all of you that are on the call to type in the chat or the Q&A field and let us know your thoughts, your request for adjustments to the survey next year or the reporting tool. And while you guys are doing that, I'll just put up this last slide that you'll get as part of the packet. Your sister association will be providing to each attendee a copy of these slides. So you'll have these contact details as well as a recording of the slides so that you can reference back what we discussed today. With that said, any questions from the crowd? A lot of information in a short amount of time. Thank you, Matt.
I appreciate the ability, Teresa, to present and help present the survey, and definitely reach out if there's any questions. And if there's none, have a happy Thanksgiving.
Excellent.
Well-
My last comment would be in the portal, there are some other tools and resources. We really focused on that analytics tool today, but there are some documents out there as well. There are job descriptions. So if you're looking at a particular position and you're not quite sure what was included in it, there is detail that describes how each position is defined. There's also a robust labor management planning spreadsheet where we look at equity and equality, we look at tenure, we look at promotion opportunities so that you can be as transparent as possible with your staff to retain, to recruit, to really build your workforce to where it needs to be. All right, let's see. Maybe a question. Very interesting. Definitely, we did not spend a lot of time on the PDF, the physical reports, but they're searchable PDFs. There's lots of great information in there that is broken down by region as well. And as always, if there's any questions, don't hesitate to ask the question so we can get you more information. If you're thinking it and you're not sure, there may be others as well. So we'll want to clarify for you. All right. I don't see any other comments. With that said, Matt, we appreciate you. Thank you for taking a look at the macro look of things, the economy, the government aspect, and we'll wait to see what happens in January.
Thank you very much.
Thank you. Have a great holiday, and we'll get this information out to the group soon. Thank you. Have a great day.